Yeah, good morning once again, traders. How are we doing today? I know for sure I'm going to have this recording. All right. I'm using my standard system that I'm used to now. So I believe everything's going to be okay now. All right. So we are going to be looking at day 2 of Forex Foundation class. Number 1, we are going to be looking at understanding financial instruments available in the market. But before this day 2 Forex Foundation class, if you have not watched the video of day 1, you have to go and watch the video of day 1. If you don't understand the video and what we did in day 1, there is no way you can have idea of what we did in day 2. So go and watch that video first of what we studied in day 1. Now we are in day 2 of Forex Foundation class. Today, we are going to be looking at understanding financial instruments available in the market. All right. And we said there are 4 primary instruments that is available in the financial market. The first one is the Forex market. The second one is the bond market. The third one is the commodity market. And the fourth one is the capital market. And it is important for you to also understand that investors all over the world, they have the money they have, they employ the best economies to look at different markets and diversify their investments into these 4 different primary markets. All right. And for instance, if I am an investor, the whole money that I have is 1 billion US dollar. I'm not going to place all, I'm not going to invest all the $1 billion into Forex alone, or into bond alone, or into commodity alone, or into capital market alone. So what they do is that they analyze the 4 primary markets and they see the ones that have less risk at a certain point in time. They move the higher percentage of their portfolio into that one. All right. And they invest less into the one that are timed to be very risky. For instance, in the time of crisis like coronavirus, during the outbreak of coronavirus, you will agree with me that there was higher prices of commodity. And why was there higher prices of commodity? You see, it was difficult to move commodity from one part of the world to the other due to the outbreak of epidemic. So as a result of this impasse, as a result of this anomaly, you will now see that there will be shortages experienced in different parts of the world. So because of that, there will be excess demand for commodity than supply. So in as much as you are having excess demand over supply, prices of commodity will shoot up. Another example is when there is crisis, when there is war, like now you have Ukraine versus Russia war. The Ukraine versus Russia war is creating a supply gap in different economy. What do I mean? You know that Russia is one of the major producer of crude oil. Is one of the major producer of natural gas. Now, and Ukraine too. So because of the problem, not much of these products are able to get across to other parts of the world. And as a result of that, there is shortage. And because there is shortage, and you know that because there is shortage, there will be excess demand over supply because there is shortage of supply, and that will alone push price to go up. You understand? Price will go up. Okay, so now let us also move to you have understood commodity market now, and why the price of commodity market will usually go up. To understand why. Now, let's look at relationship between this. No, before we look at the relationship, let's look at capital market and bond market. Bond market is simple. What do we mean by bond market? Bond market is a market that is put in place to regulate the supply of the supply and demand of money in the economy. I just told you that whenever there is crisis like epidemic, whenever there is inflation, whenever there is increase in prices of commodities like energy, this usually result to increase in prices of goods and services. How does it happen like that? Do you know that when there's increase in crude oil prices, what happens is that many things, in fact, our life depends on energy. How? The industry, they make use of energy, natural gas, to power their plants. The even aviation, they make use of energy, like crude oil, product of crude oil. Transportation, railway, all manner of things, they make use of energy. So when the price of energy increases, then there's increase in cost of production. And that increase in cost of production will also translate to increase in goods and services. And when there is increase in the prices of goods and services, it is called inflation. Do you understand now? You can see how we don't want there to be war between Russia and Ukraine, because it's going to bite hard on the economy. There will be inflation. You can hear now that the inflation that you see in the US today has never been witnessed before for the past 40 to 50 years. It is as a result of that problem. So now, when the prices of goods and services are increasing, there is inflation. This inflation, excuse me, this inflation is not good for the economy. It's not healthy for the economy. So what the monetary authority of the country will do is to find a way to reduce this inflation. And it is because there is excess money outside. That is why inflation is increasing. So what the monetary authority of the country will do is to find a way to use the instrumentality of bond issuance or interest rate to arrest inflation. Before I go on, there's what is called inflation targeting. Major economies like United Kingdom, United States, Euro economy, Australia, New Zealand, they have found a way to restrict their inflation to 2%. So if inflation increase more than 2%, there is problem. If inflation drop more than 2%, there is problem. So they will now use the instrumentality of interest rate and bond issuance to arrest inflation around 2%. So now, how does inflation, how does the interest rate, how is it used to control inflation? When inflation is increasing, the monetary authority will increase the interest rate for that country. When they increase interest rate, people who have enough money, they are forced to go and keep their money in the bank. They go and deposit their money in the bank. So the CBN or the monetary authority of that country has succeeded in mopping up excess funds in the system and stacking it in the bank. As soon as much deposit is achieved in the bank, what is the consequence on the bond market? You will see that because people are keeping their money because of the promise of increase in interest rate by the monetary authority, nobody will buy bond. Nobody will buy bond. And because nobody is demanding for bond, what happens when you are not demanding for a particular material, a particular financial resources? What happens? The price will go down. So you see that increase in interest rate, increase in inflation is going to attract increase in interest rate to bring it down. And when interest rate increase, people deposit a lot of money in the bank and ignore the bond market. And as a result, the bond prices will go down. Therefore, I make bold to tell you that economically and mathematically, interest rate is inversely proportional to what? To bond price. So you now understand why it is happening like that. And then there is a direct, excuse me, there is a direct relationship between the bond market and the capital market. Bond market and the capital market, they go in the same direction. If inflation is very high and the monetary authority has increased interest rate in order to arrest inflation, this increase in interest rate make people to deposit more money in the bank and allow bond and make bond prices to go down. As bond prices is going down, the same way capital market will be going down. Why is capital market going down? People are expected to buy. Capital market is a place where you buy the shares, you buy and sell the shares of companies. All right. So now, the same way that people, investors who are supposed to invest this money to buy the shares of company, they are now using this money, they are now keeping this money in the bank because of the promise of high interest rates. So as a result of this, there will be low investment in capital market. So as inflation is going up and you are using high interest rate to police it down, this high interest rate will make people to deposit more money in the bank, and there will be less investment in bond, and there will be less investment in capital market. So when bond is coming down, capital market is also going down. So when you watch CNN, you see that they say Dow Jones, this, that, in the US Stock Exchange, everything, NYSE. When you see that they are going down, they are red. Go and check capital market. But this is capital market is going down. Go and check the bond market. Bond prices will be very low. And go and check interest rate. Interest rate is higher. People are keeping money in the bank. That's why they are not investing in stock market. They are not investing in capital market. They are not investing in bond market. Do you understand now? You can see relationship between them. But I also may bold to tell you here that because of the high interest rate that the monetary authority is promising these people, what is the consequences on the country's forex market? That's what concerns us. So when you hear that Reserve Bank of Australia has increased interest rate, it is good news for the currency. The currency will appreciate. What will make currency to appreciate? Because who will not like to look for Australia dollar and keep, so that the interest that will be paid on it will increase? Why are you keeping money in the bank? Why are you keeping money in the bank? Why are you depositing money in the bank? Why are you fixing money in the bank? It's because you want increased interest on them. It is the interest on them that is your profit. So when the Reserve Bank of Australia increase interest rate from 2 to 3%, they are telling you that when you keep your money there, you have possibility of having increment by 1%. So by virtue of that, people will be looking for Australian dollar to buy. And because people are looking for Australian dollar to buy, what happens to Australian dollar? It will appreciate. So therefore, increase in interest rate will make the currency of the country to go up. And as the currency of the country is going up, it is not good for investment for that country. Somebody should hear me well. When the currency of the country is appreciating as a result of increase in interest rate, it is a bad news for capital market. Why is it a bad news for capital market? People are bringing money to the country. There is big foreign direct investment into that country, but not to be invested in capital market. It is to be invested in the money market, where they can achieve greater what? Return on investment. So as they are stacking the money in the money market, bond market will continue to go down, and then the capital market will continue to go down. So, but I will tell you that the bottom line why the interest rate is raised, that is affecting the bond market and it's affecting the capital market. The reason is that there was high inflation. And for there to be high inflation, there was too much money in the economy, and there was need to give interest rate to attract people to deposit money in the bank. So that as soon as they deposit this money in the bank, they are withdrawing money from the economy. And when people don't have money again, if you are selling your thing and you are mentioning a higher price, nobody has money to buy. Nobody will teach you before you drop the price for them. And therefore, there will be reduction in the general price level of goods and services in the economy. Is that okay now? I know this might sound a little bit complicated because you are not an economist, but because some of us are economists, so it's easy for us to link all this together. But I think I have broken it down to a level where you will understand perfectly. Okay, so let's move to the next outline. How are these instruments related? I've already told you the relationship between the bond market and the capital market, the relationship between the forex market and the commodity market. I've already told you. What the one I did not dwell much on is that of a commodity market. And I told you that commodity market usually experience a boom, usually during crisis like outbreak of epidemic, crisis like outbreak of war between Russia and Ukraine, between United States and Iran, between United States and Iraq. There will be energy crisis. I can tell you that. All right. And then when you have what is called socio-political event, socio-political event like election. When there is election of Hillary Clinton and Donald Trump, there was a lot of market cynicism, and we enjoy market that time. It was a serious matter. Do you understand? So when you have socio-political event, there is tendency for commodity markets to boom. Why is commodity market boom? The reason why it will boom is that people hide their money in commodity. You know, they withdraw it from forex market and take it to the commodity market. Why are they withdrawing it from forex market? Because there are situations of uncertainty in the market. As time goes on, when you are seeing what is called sentiment analysis, you understand what is called risk off and risk on environment. Risk on environment is when there is stability in the financial system of different economy, and people are trading forex, they are investing money in forex because economies are stable. There is nothing like excess fluctuation in the value of different currencies. But in a situation where there is instability in global economy, like there is recession, there is socio-political event, like there is war, there is epidemic, there will be terrible fluctuation, massive fluctuation in the value of respective countries' currency. And as a result of that, what happens? People move their money from currency and invest in commodity like gold, safe haven asset like gold, like JPY, like wheat, like sugar, like metal, silver, and all those things, like diamond and all those things. Okay, because those assets they are slow at losing value. Okay, but then in when you are looking at how this instrument are related, you should also understand what we call in economics response lag. Response lag. I just told you that when there is inflation, that the monetary authority will have to increase interest rate so that inflation will drop. All right, but you see that in terms of fiscal policy is the policy measure that is put in place by the executive, the ministers, the president. Okay, those policy measures, they take time to have effect on the economy. All right, like now when a country decide to say this is the policy is going to put in place in terms of road infrastructure, it will take like 5 years for you to begin to see the impact on the economy. That is what is called response lag. But in terms of monetary policy, all right, when the monetary authority dish out their monetary policy, it takes effect immediately, because most of the time people have anticipated some of this policy, and as soon as it's taken, as soon as it is being announced, it doesn't take time for you to go to bank, withdraw your money. And because it is your money, you go to bank, you withdraw it, you go and invest in another market. So because you know it, it's very easy. And some countries like United States, there is what is called financial inclusion. All right. Financial inclusion is actually lacking in a country like Nigeria. That is why our money market is not moving. Okay. Our financial inclusion in Nigeria is about maybe 5% or 10%. Whereas financial inclusion in a country like United Kingdom, in a country like France, United States, is about 80 to 90%. It means that everybody have access to financial services. There is nobody that cannot operate account from their phone. There's nobody that is carrying cash around. But here, we are seeing a cash economy. We are carrying cash all about. If you hold a $10,000 in a supermarket in America, they will either arrest you or they will call police for you. Why are you carrying $20,000? They will be suspecting you. You are a drug baron. Do you understand? Because there is financial inclusion in that country. So because there is financial inclusion in major economy, you discover that there is little response lag between when policy is announced and when it's taking effect. That is why when they increase interest rate, you see the reaction immediately in the Forex chart. Do you understand? Again, there are also situations where announcement is made concerning interest rate and all those things. I don't see much changes in your chart. The reason is that we have already understood that they are going to increase interest rate, and we have factored it into the purchase of that particular country's currency, where this interest rate announcement will be made. We have factored it in, and we're already buying that particular currency. So when they make the announcement, it makes no difference. That is why it will just move a little and begin to consolidate. Do you understand now? So what which is the liquid excuse me, which is the most liquid asset? I've told you forex market is the most liquid asset. In fact, the liquidity in the forex market is about 60 to 70% of the total of financial daily financial dealing over the world. All right. And we are taking advantage of this liquidity to trade the market. All right. So now, how do we take advantage of the liquidity to trade? We take advantage of the liquidity to trade by using that fast move up and down. We take advantage of it to trade market. But if you are able to follow me to the intermediate class by opening your live account under my link and allowing me to mentor you into advanced and professional status, you will discover that you are going to have opportunity of me teaching you what is called smart money concept. It's a method that will allow you to reason like the bank. Even though you are coming to the market with small money, you will be reasoning like the bank. I will teach you that. All right. That's how you can take advantage of liquidity to make money in the market. All right. So now, classification of forex pairs. Forex are classified first and foremost. Before you know what is called forex pair, there is something you must understand. There is what is called currency. When I say when you are holding my dollar USD, I can say, Mr. Emmanuel, give me my currency, give me my USD currency. So USD alone is a currency, Euro alone is a currency, Naira alone is a currency, pounds alone is a currency. But when you now want to go into international trade, that international trade must involve two countries at the same time. Okay, there is a simultaneous exchange of goods and services between two countries. And when that happens, you are no longer talking of a currency. You are not talking of a currency pair. Because if a businessman or a company in the United States has a dealing with a company in Japan, okay, there is need for them to exchange United States dollar to Japanese yen. So when USD JPY is involved, it's no longer a currency, but a currency pair, because currency pair comes to stay because there is need for international business to exist. And for you to do business with another country, you must be able to exchange your local currency to the currency they spend in that country. Do you understand now? So now that's what is called currency pair. You are going to see many of it, like Euro, JPY, Euro, USD, Euro, AUD, AUD, USD, AUD, CAD, AUD, CHF, AUD, JPY, GBP, AUD, GBP, NZD, GBP, CAD, Euro, CAD, USD, CAD, and so on and so forth. These are different foreign currency pair. All right. Now, let's move to classification of forex pair. So forex pair are generally classified into two. One, you have major pair, and you have two, you have minor pair. What are the major pair? Major pair are those pair that are combinations of some of the first tiers economy. All right, the pairs, the currencies, when major economies, they do business with each other, their currency, when you join it together, you get what is called a major currency. So what are the major currency before you talk of the major pair? Major currency are GBP, Euro, USD, AUD, NZD. These are major currency. So when you are now talking, where I used to add JPY. So when you are talking of GBP, USD, it's a major pair. GBP, JPY, it's a major pair. AUD, USD, it's a major pair. NZD, USD, it's a major pair. So you can now see that we are adding the two big economies together. So that makes their currency a major pair. And then after you have gotten this one, all other currency like Euro, JPY, GBP, AUD, GBP CAD, NZD CAD, all of them becomes what is called a minor pair. And by the time you go on in this lesson, you will discover that the peak value of a major currency is higher than that of a minor currency. Are you okay now? Then there's what is called a cross pair. A cross pair, for example, of a cross pair is AUD CAD, NZD CAD, NZD CHF, AUD CHF. These are what are cross currency. You can go back to the internet and read more about cross pair. All right. So we're now going to market trading session. Market trading session will let us know when the market is opening and different types of market opening that you have. Like market is opening first at 10 p.m. Nigeria time with Australia stroke New Zealand. They open 10 p.m. and they are going to close 6 a.m. in the morning Nigeria time. All right, but between their 10 p.m. to 6 a.m. Asia session will open in the night by 1 a.m. Okay, so it means that Asia session is going to add their own liquidity to the system by joining Australia and New Zealand session from 1 a.m. to what? To 6 a.m. There will be increase in liquidity. And after that 6 a.m., only Asia session will continue to 8 a.m. in the morning. So London session is the next session. London session will start by 8 a.m. in the morning and end by 5 a.m. in the evening. All right. And between 8 a.m. and 5 a.m., New York session will start by 1 p.m. Nigeria time. I can see that at that time of 1 p.m. Nigeria time, London session has not ended. So between that 1 p.m., though they are going to close by 10 p.m. in the evening, all right, but between 1 p.m. and 10 p.m., there is a window, 1 p.m. to 5 a.m., that both New York and London session will be together. That is what is called market overlap. Market overlap. That is the most liquid time of the market. So you want to trade when there is highest liquidity in the system, and the highest liquidity in the system is going to come during the overlap of London session and New York session. And when I ask you the question that what is the most liquid session, if you tell me London session, I will not take it. If you tell me New York session, I will not take it. You might be correct, but I will not take it. But if you tell me London stroke New York overlap, I will mark you correct, because that is the time I want you to trade. Are you understanding me now? That is the time I want you to trade. That is the time I want you to trade as a day trader. And you close your trade by 5 p.m. Why must you close your trade by 5 p.m. that London is closing? Because as London is closing and all the companies are closing their trade, as all the companies are closing their trade, let's say they are in a set trade. As soon as they close all their set trade, what happens? The Forex algorithm is already reading this their set, this is their set trade that they have closed. It will read it as a buy trade, and the market will be pulling back again. Nobody is buying, but you will not know. You think, this market is buying. No, nobody is buying. It is a pullback that is a result of profit taking, as a result of London close. But you are still gullible enough to leave your profit there, and your profit will wipe out. You understand? So as a day trader, close your trade by 5 p.m. when the when the liquidity provided as a result of overlap between London and New York is ended. All right, close your trade. Okay. So we have to describe the characteristic of Asia session, London session, and New York session right now, and then you know how to handle those sessions. New York session create a problem called consolidation. Okay, create consolidation problem. Don't trade it. Okay, don't trade in the night. It's very bad. Don't trade in the night. All right. And as this consolidation is created, what happened in the London session? London session will react to this consolidation. If the market has an uptrend, you see that the consolidation that is created in the Asia session will break down below the support of that Asian range. And as it break down below the support, it will break liquidity and now continue uptrend to the upside. But if the market want to sell, you see that the problem created in the Asian session will break to the top to pick liquidity in the top, supply, and then begin to fall down. All right, that's how you describe. That's the characteristic of the London session. Do not trade it. It's a very tricky one. It's only the expert that know how to manage their trade in the London session. It will hit you and go to your direction. But the true session comes in the New York session, because all the manipulation, all the reaction that happen in the New York session, it is in the London session. It is at the New York session that the true trend will come to the market. Are you okay now? So that is the basic description of some of these market session. So we have to describe the characteristic of each session and noting the following. I have noted those followings and I have discussed them with you. Okay. So which pair should be traded when, why, and how? Excuse me. This particular outline 9 is something that we can write a whole textbook on. It's very wide, but I will summarize it with the best of my ability. All right. So there are pairs that you shouldn't trade in the London session. There are pairs that you shouldn't trade in the New York session. And there are pairs you shouldn't trade in the Asian session. In fact, don't even trade at all in the Asian session. But in the London session, GBP USD is good to trade. Okay. When it comes to Euro USD, it's good to trade. NCHF is good to trade in the London session. In the New York session, anything card is what you consider for trading. Card. And why is it card? You see that card, Canada has 1 hour difference there's 1 hour difference between Canada and US. So in their market open, they are usually 1 hour different. Even there's some part of Canada that have the same time zone with the United States. Okay, so they are in the same region. So when you see something like USD card, you don't even bother to trade it in Asia and London session. Don't bother yourself. Just wait till New York session. That's when you see the volatility in the USD card. Now, I now gave a reference in our last lecture that if you are giving Euro card, okay, USD card, okay, GBP card to trade, all right, which one are you going to consider? Knowing that there is possibility of all of them going in the same direction. Which one are you going to consider for trading? Do you understand now? Which one are you going to consider? It's very important. So now I told you that the way you look at it is that you go to forexfactory.com, forexfactory.com. When you go to forexfactory.com, go and click news. Don't click on calendar. You know, when we started trading, they will just tell us to go to calendar. When we go to calendar, they say red folder, they say yellow folder, they say orange folder. No. But I'm telling you, it's good. But that's not what you just do. Don't click on calendar. Click on news. Go and read news about Euro. Go and read news about USD. Go and read news about GBP. All right. But now you want to consider which one to take between Euro card, USD card, GBP card. All of them have card, but you have Euro, USD, and GBP. You want to know what's happening in Euro. You want to know what's happening in USD. You want to know what's happening in GBP. You go and read the news concerning Euro. If the news concerning Euro is very bad, that even the stimulus package that European Central Bank is preparing, they don't even know how to raise the money. They don't know what they are going to do now. And the inflation in Eurozone is becoming very high. There's energy crisis in Europe and so on and so forth. Now, you mark it that Euro is no go area to trade. You go to USD, they're telling you that they are not going to approve the stimulus package that is being arranged by Joe Biden. All right, this is a negative news. They are telling you that the Fed is indecisive about the interest rate. They are telling you that the inflationary pressure right now in the United States is biting harder than expected. These are negative news. And then when you come to GBP, you are hearing that the output, the production output of British economy, United Kingdom economy is more than expected. They are telling you that inflationary pressure is now going down in Britain. They are telling you that they are telling you that the CPI consumer price index is going down as expected. You know, when you are hearing this news, you are happy. They are telling you that the unemployment rate in Britain is falling as a result of massive industrial production, as a result of massive industrial output. When you are hearing this, this is a cheering news for GBP. Therefore, out of Euro card, USD card, GBP card has potential for bigger move. So you are going to start Euro card and USD card. You will pick GBP card. Now, the next thing you do is that you go and check their technical analysis. You discover that if GBP card is lower up in the demand and it has peaked liquidity, even if all of them has peak liquidity, just trade only GBP card. All right. So the fundamental analysis strategy that I have told you here is what you should adopt and I've just given you a case study of card. You can take another case study of JPY by looking at maybe Euro JPY, GBP JPY, and USD JPY. All right, they have all have JPY. Go and read news about Euro, GBP, and USD. That will tell you they want to take either Euro JPY, GBP JPY, or USD JPY. This is how to use fundamental with technical analysis if you want to succeed. And that is why I kept on telling people, if you don't come back to the fundamental and understand it, you can never be a professional, all right? But thank God you have begun the journey towards professionalism now, all right? So items number 9, which pairs should be traded when? Okay, that's what we are treating right now. Okay, this how it will be treated. But you, as you follow me to intermediate class and advanced class, how it will be traded, why it should be traded, I will teach you there. All right, now your assignment. Your assignment. What is the most liquid financial market? Answer is, which session is the most liquid session? Which session is the best to trade Forex? Describe the behavior of Asia, London, and New York session. So based on the lecture I've given you here, you should be able, to answer this basic question. So I believe we are cool today. I believe we have made progress today. By the grace of God, we are going to meet for the 3, and we will do the outlines in the day 3. It promises to be very, very interesting. I promise you guys. I'm going to take you by hand. I'm going to take you towards this journey towards professionalism. I'm going to make sure I try my best to make sure I bring the best out of you guys. With the assignment you are doing in the group, I see that you are doing a great job, and I see that the interest and passion of many of you are there. Even though many don't have time yet, they are interested in the program, but they don't have time to partake in it. That's why I want to do my best to ensure that the recording is available for you. And I will do my best to make sure that as many that are serious to take on this craft, we understand it perfectly. Remember, this lesson is free of charge. I keep on saying it. Even intermediate is free. Advanced is free. I am qualified by every standard to teach you how to trade financial instrument from intermediate to advanced at any level. All right. But many people will say, why am I teaching this free of charge? What is my benefit? Even when I am sick, I still make sure that I get up and try my best to make sure that I don't want a Wednesday lesson to clash with Tuesday lesson. I'm recording this. All right. The reason is that this is mutually benefiting relationship. I'm going to teach you free of charge. But if you finish up your basic and you don't want to go to intermediate and advanced, no problem, you can go. But as long as you want to continue for me to mentor you at intermediate and advanced, then you must open a live account. I have partnership with 2 brokers, one in Nigeria, one in Australia. The one in Australia is IC Market. The one in Nigeria is Hot Forex. I have affiliation with them. I am a partner to them. So if you want me to continue to teach you free of charge and coach you and give you trade, then you must open a live account, either choosing that of a foreign broker, which is Australia, IC Market, or you choose a local broker, which is Hot Forex. If you choose any of them and use my affiliate link and deposit minimum of $200 into your account, as soon as I see the evidence that you have deposited money and you are ready for business, I will enroll you in intermediate class and I will start teaching you right away. All right. When you are done with intermediate class, I will take you to advanced, where you must open your account in my link. So the excess is that when you are trading, your broker is going to charge you small commission. And from the small commission, they also give me my own percentage out of it, that it is me that refer you to them. That's my benefit. But then you're also benefiting from me by me teaching you. Guys, look at it. What I'm teaching you, if I'm to charge you, is 500, $1,000. But I'm not charging that. I will teach you free. but you must open account in my link. If you don't finish the basic and you don't want to open the account, no problem, you can go. But if you want to continue your journey and you recognize what I have done for you, you want to continue with us, there's no problem, we can flow together. I believe we are done for the day. We are done with day 2. So next time we go to day 3. Thank you very much for joining and God bless you. Bye-bye.